Okay, welcome to the lecture on the introduction to risk management. This section is more important as compared to the technical analysis system because a lot about trading is about how you manage your risk. In fact, I like to tell a lot of traders not to see themselves as a trader, but see themselves as a risk manager. When you see yourself as a risk manager, you'll be a lot more profitable as compared to if you are just focused on making profits in every trade that you make. Because when you manage your risk, manage your losses, the profit will take care of itself. But if you only focus on the profit, the loss will not take care of itself. Okay? So why do we need risk management? It is the one thing that separates us from people who go to the casino, which is the gamblers. Now when you are a gambler in a casino, you will go to a casino slot machine knowing that if you lose, you can lose your whole entire capital. But when you are a trader, you want to lose your whole entire capital because otherwise that will be really blowing your whole entire account. Okay, if you don't want to become a gambler in the forex trading market, make sure you have a very strong risk management plan and risk management system. So what is risk management? It's a strategy for you to minimize your losses so that you can increase your probability of becoming profitable in the long run. Like I said, when you take care of the losses, the profits will take care of itself. And most importantly, it makes your trading business sustainable because it will allow you to stay in the game after a series of losing streaks. Now, when we are a trader, it's impossible to avoid losing streaks. It is normal to have a losing streak once in a while. So some people, when they have a losing streak, they blow their whole entire account. Some people, when they have a losing streak, or let's say 5 to 6 losses, they can still recover. So what is the main difference between these two people is risk management. If you look back to the 2008 financial crisis, there are two groups of people basically. Number one are hedge fund managers and traders on Wall Street who make money during the financial crisis. Imagine that. Whereas another group of people, which is the majority, are the hedge fund managers, the traders who lose more than 50% of their account. So back then, a study was conducted to find out what's the difference between these two groups of people. The first group of people who make money during financial crisis, while the rest of the people lose tons of money, is risk management. During the 2008 financial crisis, the top performers, they still continue to manage their risk, even though the market is going up and up and up in a bubble, right? Whereas other people, they are being greedy, they are taking excessive risk, and that's why when the market plunges, their profit also plunges. So one very important thing is to have a very strong discipline, regardless of whether the market is in the bubble, whether people are optimistic, you still need to stay true and stick to your risk management plan and not take excessive risk when everybody else is coming in and buying an asset class. For example, Bitcoin. People are taking such large amounts of risk recently because of the recent correction, market going downwards. Tons of people lose money. Because of why? Greed. Again, it comes down to discipline, which is what I'm going to talk about more in the next few lectures. So there are many ways that you can manage your risk. Number one is that you can hedge. Remember, what does hedge mean? Now, this is a strategy used by hedge fund managers. You don't need to care too much about it for now. Basically, it's when you make a buy trade, you also open another sell trade. So that when the price doesn't go the way you want it to go, your wins can cover up your losses. So some people hedge using different asset classes. Let's say they buy a stock, then they will hedge using a commodity, for example. So that when the stock plunges, the commodity increases in price, then they make money in the commodity to cover up the loss in the stocks. That's something which is related more to portfolio management, but I'm not going to cover on that right now because I just want to focus more on the basics for you. And the second way of managing your risk is to trade with a predetermined lot size, meaning that before you even enter your trade, make sure that you have a predetermined lot size in your mind that tells you that, okay, I'm going to risk just this amount and I'm going to stick to that, rather than haphazardly calculating and setting random lot sizes. Okay, that's not trading, that's gambling. And of course, another way is to trade only a certain period during the day, because there are certain periods of the day, of the week, of the month that are more volatile and hence more risky for traders. So you want to trade on days where the prices are more predictable, more stable, and hence less volatile. Also, you can have a very balanced portfolio to manage your risk. Make sure that you set the optimal stop loss level. Make sure that you set your stop loss level before you even enter the trade. Because a lot of people, the way they set their stop loss is that they're going to let the emotions set their stop loss. So before you even enter into a trade, make sure that you tell yourself, okay, I'm going to put my stop loss at this certain amount of pips for every system that you use. Otherwise, if your stop loss level is random, then your trading ROI will also be random. When it comes to becoming a risk manager, we want our trading to be as predictable as possible to minimize the risk. Another way is to trade more predictable pairs. Now, there are certain pairs, no matter how long you trade it, no matter how long you study it, just like a human being, no matter how many years you spend with them, you still can't understand them. Same for a couple of currency pairs. I would say the more exotic pairs, because they are so unpredictable. But of course, if you have a specialty in that, then by all means trade at your own risk. But personally, I just wouldn't touch on the more exotic, non-popular pairs. Because remember, the higher the liquidity, the higher the predictability. So that's why you want to trade the more liquid pairs, which are the major pairs. Now, of course, this is very important. Only trade assets that you understand. Because way too many people, they just buy into a stock, buy into an asset class, buy into Bitcoin. You see so many non-traders jumping to Bitcoin, jumping to a certain stock because of what? Popular opinion. Because everybody is doing it, that's why they are doing it. Do they know why they're buying into that stock? Do they know why they're buying into that asset class? No, they don't. They just don't. Their entry is based on just one reason. Because the analyst says buy. Because everybody else is buying into this asset class. That's it. There's no detailed research that backs up their investing into that asset class. There's no detailed testing, back test into that particular currency pair. So one very important quote by Warren Buffett, he says that risk comes from not knowing what you're doing. If you go into an asset class not knowing what you're doing, you're literally gambling. There's no difference. Because when you go to a casino and you play on a slot machine, you don't know what's going to happen. Because you're just playing the trigger and hoping for the best. When you're playing something you don't understand, you're also hoping for the best. Okay, so never ever do that. Make sure do your research before you even buy into an asset class. There's no such thing as, oh, stocks is more risky, forex is more risky, options is more risky. It is not the asset that's risky. It is the trader and investor that makes the trading asset class risky. With that, this is the introduction of risk management. I'm going to go into detail in the next few lectures.